instant gratification is not fast enough. And it's an interesting phenomenon too. My mentor, Richard Russell, said, you make 7% a year, you're a rock star. And he wrote the Dow Theory newsletters for 60 years. And one of the things that I find really interesting is that gold is up 30% last year. It's beat the S&P 500. Over 25 years, it's averaged 9.9% appreciation. The S&P was 9.6 with dividends reinvested. It's doubled the 10-year Treasury. It's the tortoise, not the hare. It's not sexy enough, and it just slowly plots along. 30% this year, that Richard Russell would say you've outpaced the Rockstar portfolio 4 times. And yet, as Rick Rule will tell you downstairs, that 0.5% of allocation from Joe and Jane Sixpack to the Harvard Endowment Fund. There is so little participation in this country that people haven't noticed it. That they are all chasing the risk-on sexy trade, the NVIDIA, the Bitcoin, the Apple, the XRP, the things that very quickly can make you wealthy, but it ignores so much of the fundamentals of wealth creation and wealth preservation. It's creating a generation of people who think that type of market action is normal. And it's not. It isn't normal. This is not a new thing. I mean, there are manias, there are bubbles, there are ups, there are downs. And while this has been unbelievable to see the type of appreciation, I think it's being ignored by the value that gold brings, the extraordinary value, its extraordinary track record over the past 25 years and last year, and its woeful under allocation. It's interesting. So yeah, the public doesn't get it yet, hardly at all to that degree. Yeah, well, you know, we talk about the law that was put into effect in 2009, the Dodd-Frank reform, where banks are no longer allowed to be bailed out. They have to be bailed in. And there was a lot of talk of that last year in March and April when Silicon Valley and Signature Bank failed. They were bailed out illegally. And there was a House subcommittee hearing inquiry where the senator from Oklahoma questioned Janet Yellen. So you just bailed these banks out. What am I missing? That's illegal. You're right, Senator. She said it is no longer allowed. Depositors are considered unsecured general creditors, i.e. last to be paid. Now, Silicon and Signature, you had Oprah Winfrey money and all the tech startup money. You had billions in uninsured deposits. She says it was an uber majority decision of myself, the President of the United States, the FOMC, which is the Federal Reserve, and the FDIC, and we all decided that these banks needed to be bailed out or it would bring down the system, too systemic. But it won't be at the expense of the taxpayer. I'm like, yeah, right. She said it'll be the FDIC. So they were bailed out. And he says, okay, does that mean if a regional bank fails in Oklahoma, my constituents will be made whole? No, Senator, they won't be. So we'll fast forward. It would require the same uber majority vote, she says. Just, it's infuriating. We fast forward to last October, just a few months ago, and little dinky flyover country, Lindsay, Oklahoma. Bank of Lindsay, Oklahoma fails. It's the first bail-in that this country has seen, and not a word was picked up by the mainstream. Lindsay, Oklahoma, with only $7 million in uninsured deposits. That's it. Not the hundreds and hundreds and hundreds of millions that Oprah and the rest of the tech startups had in Signature and Silicon, but just $7 million. And the FDIC came in, and there was one regional Fox local news channel that had a little write-up on it, and it's on the FDIC website. And it basically said that it happened on a Friday, as it always does. In fact, there was just a bank in Chicago that failed just the other day on Friday. Another one. I haven't read about it, but I did see that on the way here. Anyways, it says the First National Bank of Duncan, Oklahoma, will take over for the Bank of Lindsay, and all of the insured deposits, that's $250,000, will be made available Monday morning. In addition, 1/2 of the uninsured deposits. Now, it says that those are not supposed to be available in the Dodd-Frank Act, but they gave them half, right? 7 million uninsured. They said half of the uninsured deposits will be made available Monday morning as well. The rest will go to pay the liabilities of the bank, and anything left over, they have up to 4 years to pay out in the form of bank stock, not cash, if there is anything left over. But it said earlier in the article that the liabilities were far in excess of their assets. And so that money's gone. So let's just do the exercise. You have $1 million in the Bank of Lindsay, Oklahoma. 250 is insured. That leaves 750. You get half. That's 375. Plus 250. You get 6 1/4. and the other 375 is gone. Now, this is the law of the land, and people don't understand this. What would it be that would wake people up? You see a big regional bank, a big one, fail and get bailed in, and people will lose their mind because very, very, very well-read people reading the wrong stuff in the United States have no idea that bail-ins were part of the Dodd-Frank reform, and they're up here in Canada too. So bail-ins are the law of the land, meaning if you have over the insured limit, you're out of your mind in one of these banks. But what would it take to wake people up? That's exactly it, because when those two banks failed in 2023, we added 14,000 clients in 45 days. And that was with banks being bailed out. That's 4 years worth of client acquisition. What happens if one gets bailed in and people say, my God, they just lost everything? That's the scariest part of all to me. That's what wakes the public up. Short of something that jars them or some sort of a market collapse, I think they won't look to precious metals because people are motivated more by greed than they are by fear. They will have to, well, let me take that back. People are motivated by fear far more than they are by greed, but fear is not something that is in people's psyche until something happens. And it's about being proactive rather than reactive. The people you talk to for all these years, you're allowing them to think outside the box and be proactive. And at the point of reaction, it's too late. So, that's really my point. People won't get it, and probably until it's too late, unless they've already gotten it. And listening to you is one way that they're getting it. The best piece of advice I ever received was from my father, and I'll say this especially for younger people. I started this company in 1989 with my dad. I was 19 years old, and there was no internet, and we started in an office the size of a closet. And he borrowed money from his best friend, whose middle name was Franklin. His middle name is Miles. We come from nothing. We're the American dream. He said to me, I won't let you make the same mistake I've made as a younger man. The only rule at this company for you and I to build this would be that you'll buy something, gold or silver, every 2 weeks when you get paid, period. I don't care if it's 1 ounce of silver. And honestly, Charlotte, is the best advice I've ever been given in my life. And everyone who works for me, I say the same thing. I've owed the company outright for 2 decades. He won't fire me anymore. He said he'd fire me if I didn't do it. But I've honored my word to him, yes, because that's important to me, to honor my word, but it's learning the laws of compounding for you instead of against you, and realizing that, you might be young, but, if all goes well, pretty quick, you wake up and say, whoa, where'd all the years go? And it's easy to not prioritize your future self. So by paying yourself first and learning the laws of compounding, becoming regimented in paying yourself first, so that down the road, if you could have a discussion with yourself, I'm 54, and if I could talk to my 21-year-old self, I'd be, hey man, put some money away. So you're gonna have 3 kids and they're going to college, and you better do it. Life's expensive. And most people don't think that way. That was the best gift I've ever been given. That's the gift I would tell people to embrace, and that would be, let the laws of compounding work for you instead of against you, and always pay yourself first, because the passage of time is real, and it's never too late or never too early, really, to start prioritizing yourself. That's cool. Hey, man, it changed my life. And you wake up one morning, it's like, wow, but it's just like anything. You don't go to the gym hard on January 2nd and 3rd and then be done. You go every day, day by day by day by day, and it's the compounding of time and of effort and of interest or whatever it may be that is should be the 8th wonder of the world. And it's changed my life meaningfully, and I try to impart that upon all the people that work for me and to those few who listen. So that's cool that someone said that.
When I follow who's been buying gold, I look to the central banks. When I see what's going on in the stock market, I see the insiders selling at a 6-to-1 clip versus buying. In other words, corporate insiders are, for every one purchase, there's 6 sales. And you look at guys like Bezos, who sold 12.5 billion recently, Zuckerberg, who sold 2.5 billion worth of Meta. You look at the Nvidia insiders selling over 2 billion worth of sales. This is all year to date, but just between Zuckerberg and Bezos alone, you're at $15 billion sold. And if the economy was roaring and we would expect the stock market to continue on this massive train moving forward, you wouldn't see that happening. And so as corporate execs are cashing out, individual investors aren't. That's a premise that I would start with, that I would be very nervous. I think we can look at the bond market, which in and of itself is getting nervous as inflation concerns are again reemerging, and they really never left. I mean, the Fed pivoted, um, at 65-70% away from their lofty target rate. Was making a joke about this the other day. You're taking a cross country trip from California to New York, and you stop in Omaha and say we're there. We're 70% of the way there, but that's okay. That's good enough. And the point of it is that they haven't signaled victory on inflation. They've waved the white flag on it. And we can see that happening as the 10-year Treasury keeps going higher. In fact, the 20-year Treasury, which is something we really don't talk about very often, eclipsed 5% here just the other day. That's a big deal. That's a problem. We're getting into that point where the economy is going to start to shake and rattle, and we're seeing that with all of the longer duration maturities. And so what does that mean for the economy? What does that mean for the bond market, for the ballooning U.S. debt? And what does it say about the flood of new Treasury securities that the government's going to have to sell? Who's going to buy them? Does that mean higher rates yet still? Are we in store for a yield curve control, which will again exacerbate inflation as we create money out of thin air by the Fed to buy the debt because no one else wants to buy the debt? And then you look at all of the metrics by which we gauge, are we heading into a recession, which would negatively impact stock portfolios and whatnot. And by every single metric and then some, we're there. The reinversion or the uninversion of the yield curve, the Claudia Sam rule, the increase in money market holdings, which is up to over $7 trillion. All of these things have accurately predicted recessions in the past. And so if I were at that point where I'm very quickly going to be receiving money out of my retirement, I would not have a problem with pivoting. I would not have a problem with selling all of those stocks in my IRA that I made a lofty profit on. Get the hell out of them, just like the big money is doing, before something happens that forces you to get out. Get out now, and I would layer it into incredibly short duration treasuries. As crazy as that sounds to me, I don't know where else you go where you can feel safe and sleep well at night in a market by every single metric is classically and historically overvalued, and the insiders are bailing ship, and the long end of the bond market moving higher, where the banks who bet again that wouldn't happen are going to be on the wrong side of that bet, especially if rates really start to move higher, which I expect that they will.